Have you ever wondered which assets have actually survived every major financial crisis in history? In this video, I'm going to break down 4 types of assets that have historically been the most reliable during financial disasters of all time. The last asset on my list doesn't cost a single cent, but it might just be the most valuable one. Stick around till the end to get the full picture and understand how it all fits together. Let's go back to 1929 for a moment. New York City. 2 men, both middle class, both spent the better part of their lives putting money away. The first one is an accountant from Manhattan. He's got a stock portfolio, government bonds, a savings account at a well-known, reputable bank. His assets check every box that a financial advisor would call safe. A sensible, diversified portfolio. The kind of setup you'd look at and think, yeah, this guy's going to be just fine. The second one is a farmer from Kansas. He's got 160 acres of wheat, 20 gold coins in a lockbox, a gift from his father, and a pair of hands that knew how to fix a tractor, patch a roof, and raise livestock. Then October 1929 hit. The market crashed, banks shut their doors, and bonds turned into wallpaper. The accountant lost everything. And look, on paper, his setup looked rock solid. But everything he owned depended on the system and on people's trust in the system. And that trust broke. So what happened to the farmer? His land kept growing wheat. His gold still held its value. His skills didn't go anywhere, and his hands could still do the work. He came out of the crisis richer than he went in, without even realizing it, because the people who'd lost everything were now buying food from him with family heirlooms. And this wasn't some one-off story. There were thousands like him. He just happened to own the right kind of stuff, more fundamental assets. That same pattern played out in Weimar Germany, in Argentina, in 2008, in 2020, every single time. The same categories of assets end up standing, while the safe investments get wiped out. This video is about 4 of those assets. 4,000 years of evidence. 3 of them cost money. The 4th one cost nothing, and it might be the most valuable of all. Stick around till the end to find out what it is. Let's start with the oldest one, land. Not land as a line item on a brokerage statement, and not a suburban lot with a house on it. Productive land, the kind that grows food, holds minerals, or sits on water. Weimar Germany, 1923. The mark had basically collapsed to 0. People were burning banknotes in their stoves because the paper was literally worth more as fuel than as money. A banker in Berlin who'd spent 30 years saving marks for retirement couldn't buy a loaf of bread with them. Meanwhile, a pig farmer 40 miles outside the city was trading a single hog for a grand piano that used to cost that banker 3 months' salary. That's not an exaggeration. That's from the historical record. Farmers outside the major cities became the new aristocracy practically overnight. They could demand payment in gold, in foreign currency, in goods, and people paid because they had no choice. Food was needed every single day, and the farm produced it every single day. The currency could die, wheat couldn't. And this pattern repeats so often, it starts to look like a law of nature. Zimbabwe in 2008, farmers with land and livestock had something people would trade anything for, while urban workers with savings in Zimbabwean dollars had nothing at all. The reason is dead simple. When a currency collapses, the economy doesn't just stop. People still eat, they still need fuel, raw materials, shelter. Whoever controls the source of those things holds real power, regardless of what's happening with the money. They understood this in ancient Rome. There was an unwritten rule. To become a senator, you had to own land. And it wasn't about tradition. Land was the only form of wealth that couldn't be devalued by an emperor's decree. When the denarius lost 95% of its silver over 2 centuries, and prices shot up tenfold, senators with estates still ate. The harvest still came in. The land didn't care what was happening to the coin. There were patricians who lost their fortunes on trade speculation, but I haven't found a single recorded case of someone losing everything while owning a wheat field. And what about today? Bill Gates is the largest private owner of farmland in America, 270,000 acres. He's not farming, he's hedging. Institutional funds all over the world are quietly buying up agricultural land, not because it's trendy, but because the math on inflation doesn't leave them a whole lot of other options. Land produces food, people eat. That equation doesn't depend on what the Federal Reserve decides to do with interest rates. But I want to be straight with you. Land is not a perfect asset. It can be confiscated. Zimbabwe, the Soviet Union, Cuba. Every time a government decided that private property was getting in the way, land was the first thing they grabbed. It's a liquid. If you need cash tomorrow, you're not selling a farm tomorrow, especially in a crisis when buyers are scarce and the process drags on. And it takes work, taxes, upkeep, knowledge. It's not a set it and forget it kind of deal. But here's the thing that outweighs all of that. In 4,000 years of recorded history, from Mesopotamia to right now, productive land has never gone to zero. Not once. Currencies have gone to zero, stocks have gone to zero, bonds have gone to zero, but land that grows wheat has always been worth exactly as much as wheat was worth, and wheat has always been worth something. Second asset, gold. And before you roll your eyes, this isn't about conspiracy theories or doomsday preppers and bunkers. This is about math and about how people actually behave when everything falls apart. When a currency dies, society immediately needs something it can use as money. Not eventually, not down the road, right now. And for thousands of years, the thing humans default to is gold. Not because it's magical, but because everyone recognizes it. You can divide it, you can carry it with you. And no government on earth can print more of it. In Rome, when the denarius went from a silver coin to basically a copper slug over 200 years, the people who had real gold kept trading, kept buying, kept living. Gold didn't save Rome, but it saved people inside Rome. Now, here's a number most people don't know. Between 1929 and 1933, the Dow Jones fell 89%, 89, and shares of Homestake Mining, a gold mining company, went up 474% over that same stretch. Not because somebody made a genius call, but because when everything else is falling apart, gold becomes the thing everyone runs to. The people who held physical gold before the 1929 crash walked into the 1930s with their purchasing power intact. The people who held stocks and bonds lost nearly everything. Same country, same crisis, opposite outcomes, depending on what you were holding. In 2008, when Lehman Brothers went under, gold dipped for a couple of weeks and then started climbing, up 25% by the end of 2009. In 2020, when governments around the world printed trillions in response to the pandemic, gold hit an all-time high. And here's what's happening right now. Central banks around the world are buying over 1,000 tons of gold a year, 3 years running, more than doubling their purchases compared to the previous decade. The same people who print paper money are storing their wealth in something that can't be printed. That's not a conspiracy theory. That's what they're actually doing. Maybe we should pay attention to what they do, not what they say. But gold has weak spots too, and it wouldn't be honest to skip over them. 1933. Roosevelt signed Executive Order 6102, and just like that, owning gold became a federal crime in the United States. Citizens were forced to hand over their gold at $20.67 an ounce, and then the government jacked the price up to $35. Basically a 40% devaluation of the dollar with the stroke of a pen. The people got their safe paper dollars and the government got the gold. Confiscation is a real risk, and it's already happened. From 1980 to 2000, gold sat in a 20-year sideways grind. If you bought at the peak in 80, you had to wait until 2008 just to break even, An entire generation of waiting, and gold doesn't produce anything. It doesn't pay dividends. It doesn't generate income. Yeah, it just sits there. But here's what it does, and it does this better than any other asset in history. Gold doesn't make you rich in stable times, but it makes you solvent when everyone else is broke. That's a completely different function, and that's exactly why central banks, the very institutions that issue paper money, are holding more gold today than at any point in the last 30 years. The third asset is harder to spot, but it might be the most practical one out of all four. Put simply, it's a business that sells something you can't live without. And because of that, it charges whatever it wants. A business with pricing power. Not every business survives a crisis. Most of them don't actually, but there's a specific type that doesn't just survive, it comes out stronger. These are companies that sell things people literally cannot stop buying, and that can raise their prices just as fast as the currency falls. Think about it this way. If you make luxury handbags and a crisis hits, your customers vanish. But if you produce cooking oil, electricity, medicine, or fuel, demand isn't going anywhere. It simply can't. And if you're the one producing it, you set the price. Not the market, not the government, you. Brazil, the 1980s. This is where you can see it clear as day. Inflation was running at thousands of % a year. Picture a supermarket where an employee walks along the shelves with a pricing gun, slapping new stickers over the old ones. One price in the morning, a different one by lunch, another one by evening. Shoppers were literally running through the aisles, grabbing stuff off the shelves before the price went up again. Sometimes it changed while they were standing in line at the register. Companies that made essential goods, oil, flour, soap, medicine, kept their real margins. They raised prices every single day and people paid because not buying cooking oil isn't really an option. But companies locked into long-term contracts with fixed prices, the ones that simply couldn't reprice fast enough. They got crushed. That same principle was at work 600 years before Brazil. Medieval Venice, Venetian merchants controlled the spice routes from Constantinople to Alexandria. Pepper, cinnamon, cloves. Stuff the European nobility couldn't imagine living without. When currencies wobbled and wars shut down trade routes, the spice merchants just raised their prices. Buyers had no alternative. You either pay what they're asking or you eat bland food. 2022, inflation in America hit 9.1%, a 40-year high. And what happened? Procter & Gamble raised prices and grew their profits. Coca-Cola raised prices and grew their profits. Energy companies raised prices and grew their profits. Businesses with pricing power didn't get hurt by inflation. They made money off it. Meanwhile, retailers running on razor-thin margins, restaurants, small businesses that couldn't pass the cost increases onto customers, thousands of them went under. When does this not work? The Roman Emperor Diocletian issued a price ceiling edict in 301 AD. The penalty for selling above the limit was death. And what happened? Merchants just stopped selling, and the shelves went empty. You can't force people to trade at a loss. Pricing power disappears when a government outlaws it, or when a technological shift wipes out the monopoly. Venetian spice traders lost everything when Vasco da Gama sailed around Africa and opened a direct sea route to India. Their stranglehold vanished in a single generation. But here's the key takeaway. The asset isn't a specific company. It's a characteristic. The ability to raise prices faster than the currency is losing value because the buyer has no alternative. That characteristic worked in Venice 600 years ago. It worked in Brazil 40 years ago, and it works today. If you've got it, you walk out of a crisis with your purchasing power. If you don't, you lose it. So that's 3 assets. Land that feeds, gold that stores, a business that reprices. All 3 share one thing in common. They require capital. You need money to buy a farm. You need money to buy gold, and you need money to build or buy a business. But in every major crisis, over the last 4,000 years, there was one more group of people who came through the wreckage in one piece. No land, no gold, no business, no capital at all. What did they have? Skills. The fourth asset, the one that costs nothing, and the one almost nobody talks about. Hungary, 1946. The most extreme hyperinflation ever recorded in human history. Prices were doubling every 15 hours. Not every month, not every week. Every 15 hours. Government workers on fixed salaries got wiped out. By the time your paycheck arrived, it was already worthless. But a skilled plumber who could set his own price for each job, he ate. An electrician who could negotiate payment in food, he fed his family. Factory workers started demanding daily wage adjustments, while the folks collecting a fixed monthly salary were essentially working for free. And none of this was new. When the denarius turned to junk in Rome, the economy didn't stop either. People still got sick, pipes still leaked, walls still crumbled. And the people who could heal, fix, and build, they got paid. Not in worthless coins, but in food, clothing, services. Anything that held real value. A craftsman with a hammer and a skill set was worth more than an aristocrat sitting on a chest of denarii that nobody wanted to accept. Here's how it works. When a currency breaks down, the economy rolls back to something close to barter. And in a barter economy, the person who can fix your pipes, treat your kid, or get your car running again has more bargaining power than someone holding a government bond that's worth less than the paper it's printed on. And what about today? After COVID, the world ran into something most people didn't see coming: a shortage of hands. Electricians, welders, mechanics, plumbers, there just aren't enough of them. In America, the average age of a licensed electrician is 55. Young people are going into offices, into tech, into marketing, while the skilled trades are aging out. And at the same time, artificial intelligence is starting to take over white-collar work. Copywriters, analysts, junior accountants, jobs that used to feel bulletproof are suddenly on the chopping block. But AI can't show up at your house and fix the wiring. It can't swap out a pipe under your sink, and it can't pour a foundation. The world is heading toward a place where someone with a hands-on skill is going to be more in demand than someone with a degree in a laptop. And the wage data is already backing that up. When do skills not work? When a skill is tied to one specific technology or one industry that dies off. The typesetter, the telegraph operator, the horse-drawn carriage driver. Brilliant specialists right up until the world moved on. The skills that survive are the ones tied to basic human needs. People will always get sick. Pipes will always leak. Buildings will always need fixing. And machines will always break down. Those skills don't become obsolete because the needs they serve don't become obsolete. And here's why skills might just be the most powerful asset of the four. Zero upfront cost. You don't need money to learn. Time and effort, sure. Money, no. Can't be confiscated. The government can take your land. It can seize your gold, and it has. And it can nationalize your business, but it cannot take away what you know how to do with your hands and your head. And it can't be devalued by a printing press. You can print $1 trillion. You can't print an electrician. Skills are the only one of these four assets that's available to every single person on the planet right now. No starting capital, no connections, no permission needed. Four assets. 4,000 years of evidence. Why these four and not stocks, not bonds, not crypto, not pension funds? Because each one of them passed 3 filters that no so-called safe asset in history has ever passed. First, you can't create it out of thin air. You can't print land. You can't print gold. You can't print pricing power. And you can't print skills. But dollars, you can print those. Bonds, you can print those too. And every single time someone fires up the printing press, everything that can be printed loses value, while everything that can't holds. Second, people need it no matter what the economy is doing. Land fees. Gold becomes money when other money dies. Businesses with pricing power sell things you can't live without. Skills solve problems that never go away. Tech stocks? Government bonds backed by $39 trillion in debt? Don't pass that test. Third, historical precedent. Every single one of these four has worked in every major crisis you can check. Rome, the Middle Ages, Weimar, the Depression, 2008, 2020. The pattern hasn't broken once in 4,000 years. This isn't investment advice. Nobody knows when the next crisis is coming, or whether it'll hit in our lifetime in some extreme form. But the pattern of what survives and what doesn't, that pattern is 4,000 years old, and it hasn't been wrong yet. The question isn't whether you believe a crisis is coming. The question is whether the things you own today pass those three filters. Because when the system cracks, the only thing that matters is what can't be wiped out by a decree, a printing press, or somebody else's broken promise. Which of these four assets do you already hold? And why that one? Drop it in the comments. Most interesting answers get pinned. I break down these patterns every week. Subscribe. I'll see you in the next one.